Global gas prices, resurging air travel, and returning Asian demand could push Brent crude prices as high as $120 per barrel, Bank of America said this week, and they could push it this high as soon as the first quarter of next year. According to Bank of America, the U.S. may not be completely exposed to the natural gas crisis, but Europe and Asia are. This has led to some power providers switching from gas to oil, which has raised the demand for crude oil. Add to that a resurgence in international travel to the United States after the U.S. loosened restrictions for vaccinated travelers, along with what Bank of America calls supply rigidities, and you have a recipe for higher prices. When Bank of America talks about supply rigidities, it's talking about two main reasons for its perceived rigidity. The oil sector's terrible returns over the past 6 or 7 years that have made investors skittish, and an uncertain future of oil demand amid the much-discussed energy transition. At least some rigidity is apparent in the market, as the United States continues to pump 1.6 million fewer barrels per day than it did prior to the COVID lockdowns. Other rigidity can be seen in some OPEC Plus producers that have failed to produce as much as their newly increased quotas allow. The United States has been quick to point fingers at OPEC Plus for the current high oil prices, which major oil consumers, Japan, India, and the United States, have loudly lamented. The United States insists that OPEC Plus does not care about the economic recovery. OPEC Plus, on the other hand, has been self-congratulatory, pointing out that without its role in managing the oil market, oil prices would be double where they are now, much like natural gas and coal.